Welcome to Online Trading Campus. This is Jan Skorupinski with you today, continuing the new 2020 Forex course. Welcome to Module 3, Professional Forex Trader, Lesson 1, Global Trading Hours. This is the agenda for today. First, we're going to investigate the different trading sessions, which ones to focus on and which ones to avoid, and the characteristics of each one of them. After, we will look at an additional zone qualifier called the lower time frame trading hours zone qualifier. Of course, we will spend some time to drive home the zone qualifier, focusing on a practical application. We will end this lesson with a few additional tips on this topic. Let's go. Today's technology allows Forex markets to be constantly open and accessible to traders, of course, providing the markets are open. Basically from Australia's Monday all the way to New York's Friday. For Forex, the only market close happens at 5 p.m. Eastern due to the rollover process where the broker closes the day, collects or pays interest, and then opens for the next day. The futures market is a little bit different because this market actually closes for 15 minutes each day in between trading days. This happens at 4:15 p.m. Eastern, and then it would open again at 4:30 p.m. Eastern, and then at 5 p.m. Eastern, most futures contracts would actually close for 1 hour until they then reopen. And the stock market is only open from 9:30 a.m. Eastern to 4 p.m. Eastern, the so-called regular trading hours or main trading hours. What is the biggest problem that you may face considering that stocks are only open 6.5 hours per day? Gaps, right? One of the benefits we talked about in the beginning of this course are the trading hours of Forex. And due to the markets being constantly open, the gap risk is very minimal. Although in Forex, gaps can happen sometimes over weekends, they are very, very rare. The only market which is open longer than the Forex market is the cryptocurrency market. This market is basically open 24/7, and Bitcoin, for example, is also traded over the weekend. And you can actually also participate and trade so-called cryptos or Bitcoin over the weekend. Before we inspect the different trading sessions that result of the global trading hours, let us quickly talk about why we look at trading hours. During certain periods of the day, we can see more liquidity and price movement than in others. The focus here would be on liquidity. Liquidity could also be referred to as participation. In general, we can say the more liquidity or participation, the more chance of unfilled orders we can potentially find during these specific times. It is our job as proactive investors to understand the difference between the global trading hours and how this relates to the quality of our lower time frame zones, especially when trading daily income. The smaller the time frames we use, the more accurate we want to be as proactive investors. The Asian session runs from 6 p.m. until 3 a.m. Eastern. Here you have markets like Sydney or Tokyo that are trading. This is just because of where they are geographically. And then you have the European session from 2 a.m. to 11 a.m. Eastern, so Frankfurt and London would be open here. During those sessions, price action and volatility is usually slow but is starting to pick up. The US session is when the liquidity kicks in and the markets usually start moving, as the European and the US trading hours will overlay here for a little bit. The US session runs from 8 a.m. to 4 p.m. Eastern. That would be New York, for example. And lastly, you have what is called the dead zone, running from 4 p.m. to 6 p.m. Eastern. Here, no major market like New York or London or Frankfurt is open, and therefore prices will move very, very slowly with the lowest liquidity. So here's a nice picture to visualize the overlaps. You see the Asian session and the European session to overlap right here, but the real liquidity happens at 8 a.m. through 10 a.m. Eastern time. This is where the European and the US session overlaps. So here you can see a great example, chart example on the Euro USD. You can see when the liquidity really kicks in. It already starts during the European session, and once the US session opens and the European and the US session overlaps, that is when you get the biggest candles, meaning here you have the most participation, the most liquidity. That is when orders are being filled. And therefore, if we're going to look at lower time frame levels or zones, ideally they should be located within these timings or trading hours. And then you see a lot of liquidity all the way until the dead zone, where price just starts going sideways and the candles all of a sudden shrink massively in size. Remember, there's no liquidity during the dead zone. So here's the lower time frame LTF trading hours zone qualifier for a daily income forex trader. I'm personally a fan of weekly and monthly income, and you probably know this of me already. However, I'm also aware that everyone is different. So I'm a big fan of giving you guys a variety of tools and options to choose from, which some of you will incorporate and some of you won't. And that is also fine. But this Forex course is not a one-size-fits-all course. Plus, there's always a place and a time to be using some of these tools, even though you may be a weekly or monthly income trader in general. On the lower time frame, look for trade setups that have been formed when the two sessions overlap, basically from 8 a.m. EST to 10 a.m. EST plus minus 1 hour. On the lower time frame, avoid zones that are outside of these trading hours. This strategy works best when combined, of course, with the ideal higher time frame location and direction context. Trade with the momentum, either price action reversal candles on daily or higher time frames, or with clear impulse, meaning large high-speed candles. So let us now do a little bit of a practical application to understand how a daily income trader may be using this as a daily tool. Let's look at this Euro USD example. Trust me, it is really amazing what is happening if you backtest this strategy. Here we go, TradeStation is up and running. What you can see here is a daily chart on Euro USD. What we can see right now is a daily reversal that's happening on the euro. It's a confirmed daily reversal. Price action, we want to go short, right? So what we can do now with our new lower time frame trading hour zone qualifier, we can look at a daily income lower time frame zone, ensure this is within the right trading hours, so from 8 a.m. to 10 a.m. Eastern timing, where the European and the US trading hours overlap. And if we ensure that we find supply zones on a lower time frame, like 60 minute, 120 minute to 40 minutes, within those overlapping trading hours, we can trade them, anticipating that momentum here is going to change with our price action set of rules. And by the way, this is a back test, so we're speaking about March at the moment. This is just to demonstrate how you would be using this tool in as a daily income trader every day, and also this is to demonstrate how to generally backtest. So you can also backtest this tool on other major pairs and see how this works for you, and in generally how to backtest different kinds of strategies. So without further ado, let's go down into a 60-minute time frame, and we want to be looking for supply. So what we're gonna do is we're gonna get two horizontals in place, and those two horizontals are gonna be placed from, again, 8 a.m. EST to 10 p.m. EST. And plus minus 1 hour, what we want to find is we want to find supply that's being formed incorporating the candles that have been formed within the 8 a.m. and 10 a.m. period. So here, plus minus, I would be incorporating these candles right here, because this is usually where price is reacting from. If you want to be conservative, of course, in terms of stop loss placement, we could be placing a stop loss above here even, right? But usually this strategy, taking these areas from 8 a.m. to 10 a.m. is sufficient if you take these candles that have been formed within those time periods. Okay, so let's just go fast forward another day. So we go to Wednesday, and what you can see very nicely, price came into our supply area, and we got a new drop, and we created on a lower time frame a new high, a new low. Now that is very important. If you're trading now with momentum, what you want to see is new supply and new supply that's been formed, and you want to see new lows that are being formed. Similar to here, right, where we formed a new low prior to here. So this is always what you want to see, right? New lows. So now again, I'm gonna check 8 a.m. to 10 a.m. and right here I also have supply, and I'm gonna take those candles again right here, and I'm gonna fast forward. Amazing, right? Look at this. Price comes back in and is moving lower again, creating a new low. Okay, so we can once again look for 8 a.m. to 10 a.m. Right here. However, quite a messy area, right? Quite a messy area, quite a big area. Nonetheless, would be within the rules. It is supply. We get a new low. It is within the 8 a.m. to 10 a.m. We get a nice explosive move, and look here, we already see price reacting a little bit. Let's just go to the next day to see. Okay, nice. Also here, we can see this area is also working out nicely. So now what's happening now is I didn't get a new low. Okay, I didn't get a new low. So ideally, I do not want to use this strategy anymore, right? This means double bottom, therefore momentum should be changing. Okay, so nonetheless, we're gonna go through with the exercise just to see what's happening. 8 to 10. I have supply here and I have supply there. Right, I would have this. However, I would not be trading this. Okay, we would not be trading this. So let's fast forward a day once again, next Monday. So this is also how you generally backtest charts, right? And backtest strategy. So what can we see? Price goes up and it goes back into this supply area from where it is again reacting. Okay, so this one didn't quite work out. Now again, let's see supply from 8 to 10. So we have a little bit of supply here as well. But again, did we create a new low? No, we didn't, right? No, we didn't. So we wouldn't be trading this. We wouldn't be trading this because the supply didn't create a new low. Nonetheless, let's just check what's happening. Still worked out. Okay, still worked out. Okay, wouldn't have traded it, but it still did work out. Okay, that's nice to know. Again, let's move forward. As long as we are creating these lower lows on the lower time frame, we can look to trade it. But here obviously 2 times we wouldn't have. Okay, we wouldn't have. So here from 8 a.m. to 10 a.m. nothing much, there's no supply that would meet our rules. So therefore what we're gonna do is we're just gonna move on. The next day, 8 a.m. to 10 a.m. nice drop that we get here, plus minus 1 hours. We have a nice supply zone that's just being created right here. Okay, and we got a new low. So this is one that we would again trade. Next day, price comes in and is reacting to supply, and we go lower. Right, by now we are probably already in a very low demand area, but nonetheless, as long as we get these new lows, we can still trade it. Okay, so now let's again see. On a lower time frame, this is sort of like, inside your bell curve, what's happening, lower time frame trends that are being formed within the process, and you can see it's always these 8 a.m. to 10 a.m. areas that are being respected. And what this really means is, and this is important, you should write this down, if from 8 a.m. to 10 a.m. liquidity is changing direction, then this means that also supply and demand is changing. Okay, what do I mean by that? If we are now seeing that during the time where the most liquidity comes in, we get areas that are formed. In this case, we have supply to be formed, and that supply is holding up with the creation of new lows and new supply, then it means that the sellers are in control. Because what happens on outside of these trading hours doesn't really matter. What happens is what's happening during these trading hours. What's happening where we have the most participation. What's happening where we have the most liquidity. And if these areas start to hold, then this is a sign for us, okay, the direction, the momentum on a smaller time frame could be changing. So here again, we could be low, but we are definitely low by now. Nonetheless, 8 a.m. to 10 a.m. we have supply once again. Nothing that I would trade anymore and you would trade anymore, because we would be very, very low. But let's just continue to spin the wheel. Okay, once again is working. But guess what? It's not making a new low. And from 8 a.m. to 10 a.m. we also don't create any supply or demand, just a sideways kind of move here. So in this case, because we then also are very low, we wouldn't be, there wouldn't be anything more to trade. We probably wouldn't have even traded this one. But it's also nice to see that 1, 2, 3, 4, 5, 6, actually all the supply areas held up that were as per our rules. These ones we wouldn't have traded, but let's just assume we would have traded all of them regardless of quality. Then we would have traded 1, 2, 3, 4, 5, 6, 7. 7 of them we would have traded. 1 of them didn't work. So that's still quite a good win to loss ratio. Okay, this works very well if you have clear momentum. And, if you catch that in the beginning of a reversal in terms of your signature and price action rules, because it means you can trade reversals on a lower time frame to maximize your risk to reward potential. And if we were to continue to spin that wheel, you would see the same kind of picture. All right, so you can take a screenshot of that. if you want. And now you also know how to backtest this strategy on different kind of majors. So if that works on other majors as well, you can incorporate that into your own trading routine and strategy. So as a summary, here are some tips we just talked about during the practical application session. LTF supply should create a LTF lower low. LTF demand should create a LTF higher high. Base should incorporate the candles from 8 a.m. to 10 a.m. if applicable. This is also sufficient for protection in terms of stop loss. In general, 8 to 10 a.m. Eastern shows the most liquidity in the chart, meaning it shows the most participation. Meaning, if supply is created and holds, in general, sellers are in control. If demand is created and holds, in general, buyers are in control. All right, everyone, I hope you learned a lot about the global trading hours and the different trading sessions, and more importantly, how we can incorporate this knowledge into the real world of trading. Again, there's always a place and a time to be using some of those tools we show you during this course. I will catch you all for the next lesson. Thanks everyone, and until then, happy and safe trading, and ciao.